And if you're new, welcome aboard. Thanks for being here. We deliver workshops every Thursday with important information that will help you in the world of finance and investing. And today we're bringing you the topic You Were Warned, shining a light on the hidden enemies of your nest egg. And Mike has spent a lot of time creating this presentation with some of the most up to date, up to the minute information in it. My name's Chris Prouty. Despite the misspelling of my name in the Zoom, which I'm going to fix in just a moment, I'll be here to moderate and to keep an eye on the chat and the Q&A. Over the course of the presentation, if you do have questions, you can use the Q&A feature, which is at the bottom of your Zoom window, and just type your question in there, and I'll relay that to Mike. And then if you have general chat, you want to just say something in general, you can use the webinar chat for that. With no further ado, Mike, I'm excited to be here again this week with another great topic. Mike, one of the things I love about you and what you do is how you take 40 years of investment experience and you synthesize it into information that everyone can understand and take action on. And today I'm absolutely positive will be no different. Mike, I hand it over to you. Have a great presentation.
Well, thank you for that introduction, Chris, and let's get started. Christine was a person whose husband died in the beginning of 1978. They were a working family that worked hard, that put away some money. The insurance from her husband's that was paid after her husband's death, the life insurance policy, along with that, with a little money that they'd put aside, was enough to be invested in bonds in 1978 that gave her a decent quality of life. She could continue forward. But what happened in 1978 was not what would be the situation by 1986. 1986, if I said that right. By 1986, the bonds that had been purchased in 1978 were being called away, and the replacement bonds were paying half as much, a significant cut in pay. The consumer price index showed that consumer prices were moderating and almost flat, but the reality is consumer prices were continuing to increase on groceries and on transportation, on everything else she had. By 1986, her quality of life, her purchasing power had dropped by almost 60%. Instead of having a decent quality of life, she was facing a time in which she might run out of money. So how did she get here? We have to look back at the inflation period that was going on between the 1960s and 1970s. It started, maybe to appreciate it, you have to go back and think about the Federal Reserve and the chairman. Truman had appointed William McChesney Martin as chairman of the Federal Reserve. Martin was reappointed by Eisenhower. He was reappointed by Johnson. And inflation had already started to pick up in the 1960s. Inflation was beginning to move forward. And as it was moving forward, Martin was raising interest rates. And inflation was beginning to moderate. Nixon in 1972 was worried about winning the election and wanted to change. He was worried about a recession and inflation. The recession had probably already begun at that time. And Nixon, worried about that, appointed Arthur Burns as chairman of the Federal Reserve. And Burns wanted to lower interest rates, or Nixon wanted him to lower interest rates. Martin had already gotten pressure from Johnson. There's a funny story that goes on because Johnson had invited Martin to his ranch, the LBJ ranch. And as they're walking around and LBJ was showing him, LBJ was a tall guy, Martin was smaller. Johnson grabbed Martin by the shirt, forced him up against the wall and said, "You can't raise rates. I've got the Vietnam War to finance." And Martin didn't raise rates anymore. Burns, on the other hand, let them down. As you think about it, there's a parallel to today. We have seen the chairman of the Federal Reserve, Powell, raising rates and standing pat on rates. We have a president now that wants to appoint a Federal Reserve chairman that will lower rates in the face of inflation. And we have some potential inflation. Going back, there is a parallel to today. But going back and talking about inflation of the 60s and 70s, if you look at the consumer price index and if you talk to people about inflation, they said by the early 80s it was over. And some of the CPI really showed that. But if you look at what happened in the 60s and 70s going forward into the 90s, look at what was happening to real prices. Postage stamps, 4 cents in 1960, had increased to 15 cents to be twice that 12 years later. A Coke, 10 cents in 1960, had increased 3.5-fold to 35 cents in 1980, was up almost more than double by 92. A gallon of milk at 49 cents had increased to 218 and was pushing up to 278. A dozen eggs? We know all about eggs now. 57 cents had doubled, had in fact grown fourfold by 92. If you look at the difference in the 33 years after 1992, the increases were not that great. But if you compare the 12 years between 80 and 92, that's when supposedly inflation had moderated. What had really happened during that time is the price of oil had gone from $34 a barrel to 17. Oil had dropped by 50%. We'd gone through the oil crisis, but oil prices had dropped dramatically. In addition, housing prices had dropped 13%. Oil was the basis for a lot of manufacturing and a lot of prices going on that way. And housing is a significant part of the consumer price index. So if you look at the consumer price index between 1980 and 1992, it looks relatively flat. But it wasn't flat for people that had to live during that period of time. Not only that, a lot of the talk was about oil. OPEC came along, they did an embargo of oil. The Shah of Iran wanted to raise the price threefold. Oil, remember, was a little over $1 a barrel in the beginning of 1960s. He pushed the price of oil up, up, up until it reached $34 a barrel. That's a 30-fold increase in the price of oil. But it wasn't just oil. In 1972, the Soviet grain crop there was a drought in the Ukraine, and the grain crop in the Ukraine failed. In the Ukraine was the breadbasket of the Soviet Union. And realizing that a lot of people were going to starve to death if they didn't do something, the Soviets sent an agent to the US to talk to each one of the commodity brokers, and they talked to them privately so that no one knew what was going on. And by the time the agent left to go back to the Soviet Union, they'd purchased 30% of the wheat crop and soybeans and the grains. Enough so there was not enough wheat or grains to go around for American consumption. If you look at what happened, wheat was selling for $1.44 a bushel, and within 10 weeks, it had soared by 60%. And by fall, the price of a bushel of wheat had soared threefold to over $5 a bushel. The following year, wheat prices had come back down to the 150 level. But what had been set in motion wasn't stoppable. There was the old saying at that time that when the wheat price went from $1.44 to double, the loaf of bread, the price went from $1 a loaf to $1.50. When wheat prices descended back again to $1.50 a barrel or bushel, the price of bread went from $1.50 to $2 a loaf. What had happened is wages were increasing, transportation was increasing, everything was increasing. It was something that was called the Great Grain Robbery. It wasn't about oil. Oil had very little to do with it. When you look back and looked at that previous slide when we talked about the prices from 1980 to 1992, a lot of it was happening with the grain robbery. Why does that make a difference today? Think about what's going on in this country with droughts, with what's going on with the deportation of immigrants and the farm workers. Now, there was an article today again about some of the people that are having to let their crops rot. Cherries rot on the trees, tomatoes plowed under, because they can't get the workers to do the work. It wasn't because they're so concerned about ice and showing up. We're seeing crops that are being plowed under. At the same time, we're seeing droughts, not just in the US, but we're seeing it all over. All of that's happening, and that's driving up prices. It's giving us the great hidden wealth destroyer because we're seeing inflation increase. Even in the numbers, we're beginning to see it. The Federal Reserve looks at not the consumer price index, but they look at the personal consumption expenditures. They take out some of the consumer price index, some of the housing information. And if you look at what's happening, half of the personal consumption expenditures are related to wages, and that's been increasing. We're looking at possibly a return to what we saw in the 60s and 70s. And while you sleep, inflation is destroying the wealth. You know, if you look at what drove inflation in 2021, we had what we call demand pull. You know, I'm old enough that I remember this. I was in the business in the 1980s when people were taking apart and examining what happened in the 1960s and 70s. Demand pull means that there were too many dollars chasing too few products. Go back and think about that time. When Lyndon Johnson was president, we had the Vietnam War, and we were pumping a ton of money into the economy for the Vietnam War. We also had the Great Society, and with the Great Society, you had Medicare, Medicaid started. You had the secondary and primary school acts passed, which pumped money into the primary and secondary schools. And you had the Civil Rights Act. All of those pumping a huge amount of money in, stimulus into the economy. Think about where we are today with a Great Recession, $7 trillion pumped into the economy, and with COVID, another 11 trillion pumped in. And yes, the Fed is slowing down and taking money back out, but that process is a long process. There's still a lot of dollars, too many dollars driving too few goods. Talk about the supply chain, which has slowed the supply side. You still have a lot of dollars going through. But that was only half the equation. And this is a very easy thing to fix. You fix this by raising interest rates. You raise interest rates and slow down demand while supply catches up. That's the focus. And that's what happened in 22 and 23. We saw the Fed raise interest rates, and we saw a slowing of the personal consumption expenditures from 9% down to 3 or 4. But what happens today? There's the cost push inflation. That is what happened in the 1970s. Whether it was grain, whether it was oil, all those things were pushing cost up. When you have wages and materials rising faster than productivity, you have inflation setting in. And think about where we are. Tariff policies. We have tariffs coming into effect, which are going to raise prices. We're already seeing it. We're seeing places like Target and Walmart with prices increasing, some as much as 50% already. 50%. And prices tend to go up like a rocket and come down like a feather. We're seeing the impact of tariff. We're seeing strong spending still continuing from the stimulus package. And maybe that will begin to slow down, probably will. But we have tight labor markets. We had more strikes more strike days in 2024 than we had in the previous 10 years combined. More strike days, people going out on strike. You hear about Boeing going out on strike, the defense side going out on strike. Just a few months ago, we had the commercial side going out on strike. We're seeing more and more strikes. We'll see teacher strikes. We're seeing people pushing for wages, and they can get the wages because there's such a tight labor market. Sometimes we're seeing consumer requirements on housing. During the 1960s and 70s, what we saw was housing actually did better. Housing actually stayed up, but we lived at a different time then. We lived at a time in which you had the baby boomers coming, you had the GI Bill, which had built a lot of housing, and you had the baby boomers coming with this whole idea of getting married, having children, and buying a house. I listen to my grandchildren now. That's not what they're focused on. The strategy has changed. Will we see housing demand continue strong? I think there's some questions. The service sector, we're now a service economy. Back in the 1960s and 70s, we were primarily manufacturing. Now it's a service economy. And now there's a huge demand for higher paid service people. And even at that, talking to a server in the restaurant a couple months ago, they were saying they were getting paid more to be a server in a restaurant than airline pilots were being paid. What do you think that does to the airline pilot? What do you think that does for teachers? What do you think that does for areas where there's a tight market? They're going to want to raise wages, and those wages go up. That means businesses have to raise prices. It's very difficult. The way you get out of cost push inflation is you have to raise interest rates to the point that you force a recession, you force unemployment up so that people do not go to restaurants, they quit buying cars, or put off those decisions for a while. They quit buying clothes. They begin to reduce the amount they spend on restaurants, even if they continue to go up. That's the way you get around cost push inflation. Are we headed that way? Very, very possibly. They are. The hidden portfolio killer, the tariffs. And we're seeing that. We're seeing that happen. And we're seeing prices increase everywhere. Either companies slash profits or increase prices. And we see already what they're doing. A few have held off thinking that tariffs will go away. But what we're seeing all around are companies that are raising prices. We see it on the consumer side first. We're seeing it on the manufacturing side as well. Prices are increasing. The purchasing managers index is one where when a company is expanding, the first people that know are the purchasing managers. When they're contracting, the first people that know are the purchasing managers. We're seeing prices increase even as the purchasing managers are slowing down their purchases. It's in addition to that, we're beginning to see boycotts happen. The travel industry is going crazy right now because not crazy because they have so much business, but crazy because their business has dropped off. We're seeing slogans like the Canadian slogan that says, buy Americans, buy Canadian. BYE Americans, BUY Canadian. We're seeing websites spring up that talk about this is a product made in the United States. This is a product made in France. This is a product made in the United States. This is a product made in Canada. We're seeing those websites spring up, boycotting our manufacturing. Not only are we seeing prices increase, we're seeing boycotting going on. That's leading to reduced demand, not what we would like to see. Labor markets, I talked about the number of strikes going on. I talked about the service sector. Businesses are facing higher labor costs. You don't eat those costs very long. What was happening in the 1960s and 70s as wages went up and as material prices went up, companies were having trouble keeping up with price increases. They would raise prices only to have suppliers and their workers want more in wages and their suppliers want higher prices. It was tough keeping up with price increases. Demands are raising quickly. Housing costs, I talked about this, um, baby boomers are very different from Gen Z people. They don't have the same focus on having a family and buying the house. And then when you have a few children, upgrading the house. Things have changed. Things are changing. Mhm. And of course, the whole thing returns to stagflation. This is a time in which you have a recession going on at the same time you have inflation. I've alluded to that some in this presentation, already talking about inflation, talking about the potential of a recession. And as we get more and more into boycotting products, as prices go up and people slow down their buying, we're going to see the very possibility of stagflation. There's studies that have been done that show if somebody is intending to buy an armchair and the price is $400 and they wait a little while and the price goes from 400 to 600, even if their wages go up by 50%, they'll look at that chair having a 50% increase and they won't make the purchase. That's just the psychology of the whole thing. Even though wages increase enough to keep up with products being sold, people shy away from using them. And we're seeing COVID money run out. So I've heard people talk about the stock market as being a place, invest in stocks. Stocks will offset the inflation. This is what the market did. In 1966, the Dow reached 1,000, and I've talked about this so often. The Dow reached 1,000, and then it dropped off 20%. Then it rose back to 1,000 and dropped off 30%. Then it rose back to 1,000 and dropped off 40%. Then it rose to 1,000 and dropped off another 20%. And finally back to 1,000, began to drop some, and in 1982 took off and went from, in 1982 to 2000, went from 1,000 to 10,000. And yes, we did have consumer inflation, as I mentioned, during that period of time. But for a period of 16 years, if you'd gone away in the middle of 1966 and come back in the middle of 1982, you could have said, gee, the stock market is flat. Sorry, it wasn't flat. The stock market didn't keep up. Gold, I have to say, gold in 1972 took off and soared. But then you also have to think about in 1933, they fixed the price of gold. The dollar was fixed to gold. So gold cost $32 per ounce in 1932 and at the beginning of 1972. And as inflation was taking off in the beginning of 72, central banks were trading their dollars for gold in Fort Knox. And Nixon was concerned that all the gold would be depleted. We would get dollars for the gold, but all the gold, the backed currency, would be gone. So he lifted and decoupled the gold from the dollar, and gold went from $32 to $800. That was then. Right now, the price of gold is not fixed to the price of the dollar. And in theory, gold should keep up with inflation, but gold has no revenue, has no earnings. Maybe it will be, and maybe not. What can you do? You know, and we've been working with our clients since 2016 to see their portfolios increase, because if the dollar drops by 70%, that means you need three times what you think you need to get through that period of time. And well, what we're seeing today is what the stock market did during that time. If you look at specific stocks, 100,000 invested in McDonald's in 1966 would have grown to $1 million, would have grown tenfold by 1981. 100,000 in Arrow Electronics would have grown to 2 million. Advanced Micro Devices, that's one I personally know. I invested in Advanced Micro Devices at $10. 6 months later, it was at 30, and for years and years, I thought I had done so well. I'd tripled my money. But had I waited, by 1986, 1984, 12 years later, that $10 stock would have been $1,756. When you look at these companies, McDonald's was a change in lifestyle. Absolutely a change in lifestyle. In 1966, very few people believed that a small drive-up restaurant selling 19 hamburgers with no place to sit down and eat would be very significant. It's hard to remember that now in 2025, but in 1966, 40 years later, 60 years later, it was a change in lifestyles that became a significant change when you think about fast food. Arrow Electronics, what they did is they repaired radios. Back in 1966, radios were tubes. And if a tube failed, either you could go order a tube from somebody or you took the radio in to be repaired. The same with TV. Arrow Electronics was a little radio repair shop in Colorado who realized that those tubes were going to be replaced by transistors. And they became a distributor of transistors, and they grew that business. That was a change in technology and a change in lifestyles as well. Advanced Micro Devices, a change in technology. Going through this whole process, through the 1966, the companies that did well were the companies that tended to be smaller. I talked about that last week. They tended to be companies which were moving on changes in technology, changes in demographics, changes in lifestyles. That's where things went. That's where things are headed in the future as well, probably. We're headed into a period of time where AI is going to make a difference, where synthetic biology is going to make a difference. And some of those companies don't exist today. It's being at the right place at the right time, and it's being prepared for it. A lot of investment strategies are going to fail during this period of time. What we've been doing since 2016, very aware of what's going on for our clients. We want to make sure that our clients have more than enough, a big margin of safety in their portfolios, having extra funds to meet the challenges. And if none of this happens, think about it. If none of this happens, all you'll have is more money than you need. But if it does happen, you'll have enough to meet it. It's a time in which, in action, every month that you're not optimizing the portfolio, inflation is even now beginning to steal the future. It's not a theory, it's math. And if things get worse, portfolio needs are even greater. We've been doing that for our clients. We intend to continue to do that for our clients. If you're not there, if your portfolio is not adjusted for that, you got to think about that. So the best time to prepare was yesterday. The next best time is today. This is a period of time which is unusual, it's different, and yet it's the same. We have a Federal Reserve that has raised interest rates, that's bringing interest rates down, and a push to continue to bring interest rates down, even as we face a recession. Normally, bringing prices down, you do bring interest rates down during a recession. But we're also facing, with tariffs and with other things going on, we're facing significant price pressures, wages increasing. That's a process that continues on. Anyway, that's where we are. Hopefully, you take this seriously. We've been taking it seriously for 10 years. Well, a little less than 10 years. But that's what we believe needs to happen. So with
So
that,
Mike,
I'll
Mike,
open
great
it up
job on
for
that
questions.
presentation. I have some questions queued up and ready to go. And for everybody who's here right now, it's Chris Prouty talking. If you have questions or comments that you want to make, you could either use the webinar chat to do that, or you could put them in the Q&A section and I'll relay them to Mike. So Mike, here is from JJ. He says, and JJ, welcome aboard. Nice to see you this week. JJ says, if you're correct about inflation going higher, the CPI report on Tuesday, August 12th will be a big day if inflation is reported very high and will put pressure on the Fed not to lower rates and scare the market about the possibility of stagflation. What's your thoughts on that?
The current Fed doesn't regard the CPI very, in the process of all the data they look at, the CPI covers a broad area. It covers housing. So what they really look at is the personal consumption expenditures. And if you look at the personal consumption expenditures for the last 3 months, they've been increasing. And the portion that they really look at is the 50% that's related to wages. Consumer price index between 1980 and 1990 was pretty flat. There wasn't a lot of increase. But if you look back on the charts and look at the prices, look at the prices between 1980 and 1992 when the consumer price didn't do much. The Fed is very aware of that. Oil prices were down from $34 a barrel to $17, and housing prices had dropped. We're not seeing housing prices drop, but we're seeing seeing the potential. If it's drill, baby, drill, that brings oil prices down. And oil prices coming down means CPI comes down. Doesn't necessarily translate in this personal consumption expenditures. So August 16th, it's not the Fed watching those numbers. It's Wall Street watching those numbers. It'll make a bigger difference to Wall Street than it will with the Fed. So,
And Mike, speaking of Wall Street, Dale has a question. Corporate earnings continue to be strong for the most part. Does that predict a strong future stock market?
the stock market is driven by earnings. The question is the PE ratios. Right now, PE ratios are really high. And what we've seen is the contraction of PE ratios in times when the market makes a correction, and you haven't seen a similar thing in terms of the economy. Right now, we're seeing a time in which the economy and certain areas of the economy are stagnating. There are going to be certain companies where the PEs and the earnings ratios continue to chug along. It's going to be not a general economy or general stock market that moves up. Look back at the charts that I put up. During this period of time, a lot of contraction. During these periods of time, the expansion was very much not related. You didn't see earnings drop 20% and then expand back. You didn't see earnings drop 30% and back. You didn't see earnings drop 40% and then back. What you see is a contraction of the price earnings ratio or the price earnings. You see a contraction, you see a contraction, you see a contraction, and in these periods of time, an expansion. So it's only partly related to earnings. It's related to a contraction and expansion of the ratio. So yeah, earnings can get much better. And if they're contracting, the stocks go down. On the other hand, earnings can slow down. And if the PE ratios are expanding, the stock market goes up. What we're going to see is a shakeout in a number of these times. And there are going to be companies where earnings continue to do well. Doesn't mean the stock price doesn't go down for a while. But in the long term, if earnings are up, the stock prices will be up. I hope that answers the question, Dale.
While we wait for Dale to let us know if you answered, I will say if you do have a question or a comment, you can hit me up in the chat or in the Q&A. And Mike, somebody asks how the market reacts to tariff announcements versus implementation.
So if you look at what's going on in the market today, if you look back at this period of time in 1966 to 1980, you didn't have computers driving the stock market. Today, 95% of the trades that are done by computers and with computer algorithms. I think last week I talked about a person that was on my radio program and lending trade. The algorithms read the news, they read the stock reports, they read tweets. So they tend to react much faster than a human being can react. And we've seen stock market crashes, flash crashes, when they read a tweet and get it wrong. So we're dealing at a very different time. And if you play Wall Street's game, there's no way to beat Wall Street. The only way to beat Wall Street is not to play their game.
Let's see, Mike, I'm just going through some of the comments. Somebody's asking about hedging currency exposure, especially with the dollar.
That's beyond what I do.
Yeah.
Um, I mean, that's, in my opinion, real speculation and
Mm.
trying to guess the right moves for currency. But there again, you're playing against commodity brokers who are dealing with different things, and you're dealing with people in the commodities market, with people who have inside information. Um, they know what's going on, what the situation is in Russia, for example, that Russia's reaching the point that they're getting very close to the period of time they were during the collapse of the wall. Uh, Inflation is very high. They're talking about inserting price controls. For somebody that's trading currency, those things have a significant impact, especially if you can know that beforehand. Can you hedge the dollar? Yeah, it's probably not going to make a lot of difference because what we're seeing in this country, the inflation, is probably going to be worldwide. If you think about where we stand debt wise, total worldwide GDP is $100 trillion a year. Um, Total worldwide debt is 300 trillion. The, the only practical way out of that is to inflate your way out.
Hmm.
We'll probably see worldwide inflation. US could be worse than, but who knows? Anyway,
Mike, I have another question coming up, but before I get to that, I put in the chat the quick note. Being here today means that you're serious about keeping an eye on your investments. And if you'd like to have Mike take a look at your portfolio, and this is not a sales call, this is Mike just looking at your portfolio and giving you some practical advice, you can email him directly. And I included his email address. You'll find that in the chat. So Mike Dale says, yes, you did answer his previous question. And then he comments that the S&P 500 is hard to beat. And he's wondering how you've done it. That actually calls back to last week's presentation.
you know, I do it because I don't play Wall Street's game. My focus is long term. I'm looking for companies that are emerging. Um, if I go back to, oops, I'm looking for the companies that did well in the 1970s and the 1980s. The McDonald's, that was a change in depth in lifestyles, a significant change in lifestyles when you think about it. Today, it's been normal. One of the stocks that was in my client portfolios beginning in the early 90s was a company. I actually lost a client over it. Um, it was a company where people said, who's going to pay $5 or $4 for a cup of coffee? You know, the client I lost said when McDonald's came out with McCoffee, Starbucks would go bankrupt. You know, that was a change in lifestyles. You know, uh, Dale, in the 1990s, late 1980s, it seemed like there was a new coffee stand on every corner of Seattle. Um, People were more than willing to pay $4. It was one of the petite indiscretions, as they were called back in that time. People were willing to pay $4 for a cup of coffee when you could go to restaurants and get a cup of coffee for 50 cents or 75 cents. That's a lifestyle change. Um, there's demographic changes going on. You have to think about Gen Z and what their focus is. And I talk to my grandchildren all the time about their thoughts. And believe me, their thoughts are very different from mine. A lot of their values are the same. There's been, through the couple of generations, some significant values passed on. but for their outlook on marriage, on children, on housing, on cars. I have a grandchild that works for a software company who makes significantly more than the average wage in Seattle, who has a bicycle and only a bicycle and no car. If he needs a car, he can rent a car. I mean, when I turned 16, I wanted to buy a car.
Hmm.
That was significant. I used to say, what was it, 10 years ago? Uh, some of the grandchildren who were turning 16. When I turned 16, I desperately wanted to get my driver's license, and so did everybody around me. I looked back 10 years ago when you had the kids turning 16, and I used to think that they understood not to text and drive at the same time. And rather than drive, they wanted to keep texting rather than driving. I mean, their strategy has changed. And that's understanding that is important as we move into the next 10 years or 20 years, understanding where they're coming from because they're the ones that are going to be the consumers.
Mike, in last week's presentation, and for anybody that was here, you'll remember this. And if you weren't here and you wanted a copy of that replay, you can email Mike and he'll send you a link. You talked about the time between the IPO and the insertion into the S&P 500 and the things that you look for, including lifestyle, demographic changes in that time between IPO and insertion into the S&P 500.
Absolutely. I've talked about AI and synthetic biology.
Mm-hmm.
Those companies are coming. Uh, things far beyond chat GPT. Um, the 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 thing about AI is they only deal with historical data. Projections are not really there. Synthetic biology. Um, I mean, there's products which you're now consuming where the DNA has been synthetically created. I shared this story that my granddaughter, will be a senior at UCLA, she has a summer internship at a research lab. She created a virus, not something that existed before. And it closed off another virus. It shut down another virus. Those things are happening. It's beyond my pay grade to understand how she did that or what's going on. But creating a virus to attack another virus, it sounds almost like science fiction.
Mm.
But the reality is it's happening.
Understanding how it's done is beyond your pay grade. Understanding how to profit from it is within your pay grade.
That is, for
Well
sure.
within your pay grade. Mike, that wraps up all the questions that we have for today. As I always say at the end of these things, if there's a topic that you'd love us to cover, you can pop that into the chat for me to catalog and we'll create that. Many of our, Mike, you know this, many of our most popular presentations have been ideas from people who have shown up. So if you have a question and you'd like us to cover it in one of these sessions, you can let me know in the chat right now. And once again, thank you so much for being here today. Mike's email address is in the chat. And even if you don't want to email him right now, it might be a good idea to take that email address down so that I think you'll find as you're thinking about the topics that we covered today, you might come up with a couple of questions and you might want to get some guidance from him.
Thanks for
Thanks.
being here.
Mike, here's a topic idea from JJ, a deep dive into the 1970 to 1979 stock market and how everything performed with inflation, the US dollar, gold, and other assets. I'll capture
Good.
that for us to talk about. Thanks, JJ. Really appreciate your feedback as always. And
We're
I'm just
really,
going to, one more time, thank everybody for taking time out of your schedule for being here today. I hope you had a great time and certainly hope you learned something. Mike, I'll hand it off to you to bring this thing home.
well, thank you very much. And take care, everyone. Have a good week. And next week, we'll be back with another topic of interest. So
Keep an eye on
take
your
care.
email.
Bye now.
Hey, Mike, I'll see you later on.